Hello, everyone. Welcome to this webinar hosted by South Pole. Today, we're going to be looking at the carbon market in 2024, looking at future trends of the market. A little housekeeping, everybody's on mute. If you do have questions, please feel free to submit them at any time. You can submit via the question box. If we don't answer your question, we will respond to you via email, and there'll also be a recording of the session. Alexi? Okay. Who are our panelists today? Myself and Alexi work on the portfolio team here at South Pole. Ritika and Judith are on the policy and strategy team. So on the portfolio team, we sit between the sort of demand and supply side of the business, so track market trends, pricing, etc. And Ritika and Judith are both experts in compliance markets, Article 6, and Corsia, many other things as well. So a little bit about South Pole as a company. We just celebrated our 18-year birthday as a company just a few months ago. Currently, we have around 800 employees over the globe. South Pole is a climate company. We help our corporate clients with decarbonization roadmaps. We help them on their net zero journey. We have projects teams all over the globe, and similarly, we have sales teams working with our retail clients in regions all over. So really very much a global company. To date, we have abated over 200 million metric tons of CO2. The agenda for today, we're going to look at the role of carbon markets in achieving net zero, take a look at some of the big changes that happened in the market in 2024, and then looking ahead, some of the big trends to expect in the future. This slide is hopefully not new information to anyone on this call, but just some of the really devastating effects of climate change that we can expect in the future, some of which we're already experiencing today, floods, fires, etc. The planet keeps getting hotter and hotter, and basically we need to do something now if we want to avoid the worst outcomes. This slide is just basically to show that if we were to continue on our current path, business as usual, that's sort of the red chunk of this graph. We will not avoid those negative outcomes. We're not on track to keep the planet within 1.5 degrees Celsius of warming. We really need to take action, and emissions need to peak in 2025 to reach a net zero future. Alexi, you're muted.
Thanks for that. As it stands today, it is net zero without a high integrity and functioning carbon market. The UN has identified the need for large amounts of private capital to be deployed towards climate action, and carbon markets allow us to do that with the speed, scale, and efficiency necessary to mitigate the effects of global warming.
Alexi, your audio is breaking up a little bit. Would it be possible to go back and redo that?
Yes. Okay. Can you hear me all right?
It's kind of a spotty connection.
Okay. Let's get some thumbs down. Maybe just to, I'll go off camera to reduce bandwidth if that's useful.
Okay, let's try that. We were on the 9th slide.
The reality is there is no net zero without a high integrity and functioning carbon market. As the UN has identified, there is a need for large amounts of private capital to be deployed towards funding climate action, and carbon markets allow us to do that with the scale, speed, and efficiency necessary to mitigate the effects of global warming. Now, for carbon markets to actually unlock their full potential, there's a need for reformation within the market. I think this is something we all know, so that we can actually rapidly reduce and remove emissions and invest in future solutions to mitigate climate change. There's three ways that we can reform these markets, and these activities are ongoing. To start, we need to restore trust and integrity in the market to make sure that 1 ton is 1 ton. And a big part of that will be having kind of a standardized global agreed upon standard of what is a high integrity credit, right? Not just within the voluntary carbon market, but within national compliance schemes and international trading and CORSIA, etc. Number two, we need to innovate the market in the way we use it to solve global challenges. So we need a more advanced market infrastructure that is more reflective of mature markets. Right now, carbon markets are still in early market, and we need to innovate in this. We have more transparency, greater liquidity, and greater opportunities for price discovery. I'm seeing thumbs down. Are we still not able to hear?
You're breaking up a bit.
Okay.
I,
I'm
I
also
think, sorry.
I think it might be the server of GoToWebinar because you're also breaking up a bit. Maybe go slower. So, if reformed, carbon markets could be a powerful tool to rapidly reduce emissions and invest. Okay, I'm still seeing thumbs down. Lily, do we maybe want to switch who's presenting? It might be an internet issue.
Why don't I try the next slide and we'll see the feedback.
Okay.
Can we go to the next one? Okay. 2024, a lot of reform happened in the carbon market to sort of address these questions around integrity. Oh, still a lot of thumbs down. Let's see. Is it better with camera off or still not working very well? Okay.
Please bear with us as we work through some technical difficulties. Can everyone hear me all right? Please give thumbs up. Great. Okay. Love to see that. So 2024 itself has been a pivotal year for carbon markets. To start, we have a greater standardization of quality, and we're back to thumbs down. Okay. Well, I think right now we don't have many other options, so we're just going to have to work through with what we have. Sorry, everybody. We have greater standardization for quality carbon credits, largely at ICDCM with core principles. There's also greater guidance within the EU, the UK, and US, so regulation of voluntary carbon credit use, with the EU and California involved there. A new era for global carbon markets, with Article 6 developments from COP29 and the CORSIA adding new standards within their program. So despite a few years, markets have remained resilient. We still see record levels of retirements despite the slipping in prices, which is a good sign and something to look forward to. So on the supply side, when we talk about greater standardization, with the the need is there's many different standards and methodologies within the market, a very stratified ecosystem, and the work that the ICBCM is doing with the core carbon principles provides clarities into standards and standard bodies that align with core carbon principles, as well as the methodologies that they use, and whether those align with what is considered a high quality carbon credit. This is extremely important because it helps demystify many of the complexities within the market to ensure that the market is more accessible to your average buyer. And we hope to see this standardization continue across not just the voluntary carbon market, but also regulated markets, national markets, and other compliance markets. So what are these implications for buyers? So you can use the core carbon principles as kind of an initial understanding or an alignment. It's important to also understand the context with the core carbon principles. There are many project types that have not had their methodologies assessed yet, so there is kind of a lack of supply in the market right now, CCP credits and certain methodologies that will not be assessed until next year. So this is a great starting way to assess projects within your portfolio, but it's also important to understand that the core only actually address the methodologies in the standard body. It's still important to conduct due diligence at the project level to understand individual projects. There's many resources you can use to do that, whether that's internal due diligence efforts, third-party raters, or outside due diligence. In 2025, what we expect to see is further assessments of these methodologies, especially in the clean cooking space, and hopefully more kind of acknowledgement of the work that ICBCM has done beyond just the voluntary carbon market, but hopefully into other markets like Article 6 and beyond.
So, hi everyone, I hope you can hear me. So, voluntary claims guidances. No, you can't hear me. That's very bad. Okay. Let me give it a try if it's maybe slower. Guidance around corporate climate claims based on credit use is still a work in progress with various different responses from the market. Harmonization of guidances are therefore essential to create a benchmark for climate impact and for substantiated good claims and help companies making them. Also, the fact that there are so many various guidances, and these guidances are aligning or engaging with regulatory bodies such as the European Union, this shows a convergence between voluntary and regulatory. As we navigate this changing landscape on claims, South Pole's view is that all claims need to be substantiated and transparent and verifiable. There should be room for a range of substantiated claims, including action taken on annual and abated emissions on the pathway to net zero, such as beyond value chain actions. There should be a new framework, and the new framework should consider claims based on all credible credit types, so both avoidance, reduction, and removal credits. And it should be all under established carbon standards, which are also aligning with new initiatives such as the Integrity Council for the Voluntary Carbon Markets that Alexei mentioned. Now, if we move to the next slide, we can look into the claims regulations. So if Alexei, can you? Yes, thank you. So there are more and more attention to corporate climate commitments, and this is turning towards regulatory oversight. So there are several country governments, and some of them goes back as far as 2012. They have published guiding principles and certifications for environmental claims. And some of these examples are from the US, the UK, or the European Union, or different member states of the European Union. And to build public and investor trust in corporate climate, governments are starting to set guidance on how companies should communicate their climate efforts. So while this direction has taken slightly different forms in various different jurisdictions, the overarching goal of claims-related regulation is to establish an even level of playing field and provide clarity for assessing these corporate claims and marketing messages. So the growing focus on regulatory initiatives underscores this rising scrutiny, which is placed on accuracy and transparency of environmental claims across different jurisdictions and different regions. There are more countries that are likely to follow in mandating transparent corporate reporting about how they climate action claims reflect emission reductions within and beyond their operations and value chain. So as such, it's key for businesses to stay informed about these regulatory developments and adapt their practices to ensure compliance, safeguard consumer trust, and remain competitive in this very much rapidly evolving landscape. So if you only take one big message away from this slide, it is that all claims need to be substantiated and transparent, which is very much a common call, and it's a common call to action across all claims-related guidances that we have seen so far.
Amazing. So the next key development in 2024 was regarding compliance carbon markets, as with the closure of the latest climate change summit that was that finalized 2 weeks ago in Azerbaijan, Baku, COP29. A new era for global carbon markets began under Article 6 of the Paris Agreement. Please let me know if you can hear me okay. With a thumbs up. Amazing. Thank you. So the main outcome of this year's flagship climate summit was a new climate finance deal. And in this deal, wealthy nations will be taking lead in providing at least $300 billion to developing countries per year by 2035, which is a tripling of climate finance of climate finance from the developed world, from the current targets of $100 billion. However, there are mixed reactions to this outcome, of course, because this agreed target appears to be a far cry from the $1.3 trillion that some experts put forth as the amount necessary for climate finance. For the purposes of today's webinar, though, we are most interested in the COP outcomes for carbon markets, and that's the primary element that I'm going to cover for the next few minutes. COP29 achieved a historic milestone with the finalization of the rule book for Article 6 that has been under negotiations for 9 years now. This is significant and is seen by us as UN's endorsement of carbon markets as a key financial instrument to deliver on the goals set under the Paris Agreement. For those in the audience that don't follow the UN carbon markets very well, let me simplify what Article 6 says. The Article 6 of the Paris Agreement outlines the rules of the game for global compliance markets under the Paris Agreement. Simply speaking, this particular article allows countries to collaborate with each other when they are achieving their climate targets. Two routes of such collaboration are defined in the Paris Agreement. You must have heard of countries like Switzerland or Sweden in Europe signing agreements with other developing countries around carbon trades, and such engagements essentially are codified under or have to follow the rules defined under Article 6.2. These rules allow for carbon assets generated in one country to be used towards the climate targets called NDCs of another country, or towards CORSIA compliance. CORSIA is the compliance scheme for international aviation that my colleague Judith will cover in detail in a bit. These rules essentially mean, or Article 6 essentially means that countries can now set their own terms for carbon trading under Article 6.2, but they must report these transfers and the use of carbon assets to the UN. Integrity in such a market is ensured by avoiding double counting, and double counting is avoided through what is called corresponding adjustment in the UN sphere. So in an Article 6 deal, essentially the emissions that one country, typically the buy side, takes out of the emission of its emission balance needs to be added back in the emission balance of another country. Now, Article 6.2 was already operational before Baku as well. right? There were some rules, especially around infrastructure and reporting requirements, that were still to be fine-tuned, and that's what we achieved in Baku. So these rules include those on how registries would function, on how authorizations would be granted to projects, and what would be the reporting infrastructure and the rules around transparency, essentially. A finalized Article 6 rule book now essentially means that we have clear rules of the game and we can forge ahead on scaling this market. The key buyers in this compliance market are national governments, airlines that are obligated under CORSIA, and companies that are obligated to meet their national country targets, essentially. Baku decision also operationalizes a UN approved carbon standard under Article 6.4. Article 6.4 created this UN managed mechanism, which is also called Paris Agreement Crediting Mechanism, or PACM, which is an emerging standard for high quality carbon credits. We saw already on the first day of COP a breakthrough by agreement on two essential standards that operationalize PACM, one on defining methodologies and other on carbon removals. Now, with the finalization of the UN rules and this new and the operationalization of this new standard, to the world, in our view, will see an emergence of a viable UN-backed compliance system to broaden and link carbon markets across the world. Now, we must note that this new market develops alongside the existing voluntary markets, and in our view, interoperability between these markets is key. It is good to keep in mind that already the transactions under Article 6.2, and South Pole ourselves has done the first Article 6.2 trades about a year ago, can be done using credits that are issued by the new mechanism under Article 6.4 or PACM. But it can also use existing independent standards such as Gold Standard and Vera. As I mentioned, we are already seeing some domestic carbon pricing schemes allow the use of credits to offset national obligations. In that sense, we see voluntary markets, domestic compliance markets, and international markets under Article 6 becoming an interoperable market that evolves, that follows some hybrid models which sees different standards. What does this mean in terms of what are we looking for in 2025? In 2025, we anticipate transactions under Article 6.2 to continue to scale. We are already seeing some of these transactions happening in 2024. At South Pole, we are developing a pipeline of it most for about 24 countries. We also anticipate that the A64 standard comes into its shape in 2025 with the ability to develop new methodologies and hopefully new projects in the coming year. A high integrity, potentially high transaction cost mechanism is under the making under Article 6.4 in our view, which should provide the basis for building a high price market as well. We anticipate the A64 standard to be particularly demanding, and this benchmark for integrity is likely to spread across the market to other standards as well. What is yet to be seen is how whether the demanding nature of this standard, what are the implications it has on the viability of certain project types, and how to ensure wide use of the instrument by different countries. There's a lot more to unpack, but I would now move to the next, give the slide to Judith for a discussion on CORSIA.
Thank you so much. So I don't know how many people are here from the aviation industry, but let's dive into this scheme for the international aviation. So the aviation sector is one of the fastest growing contributor to global greenhouse gas emissions. However, as Ritika talked about the Paris Agreement before, the Paris Agreement only covers domestic aviation, and for this reason, the International Civil Aviation Organization has established a carbon offsetting and reduction scheme for international aviation, which aligns with the goals of the Paris Agreement. CORSIA aims to stabilize global airline emission, while innovations like sustainable aviation fuel are given time to develop. So airlines can comply with CORSIA Phase 1 by using CORSIA-eligible fuels or CORSIA-eligible emissions units. ICAO has set out certain specific requirements for these units to be surrendered for CORSIA compliance. And one of these requirements for these eligible emissions units is to be accounted for under the rules of Article 6.2 of the Paris Agreement, which was previously discussed. This means that these units used for CORSIA purposes needs to be correspondingly adjusted, so the host country can no longer count that emission reduction towards its national climate targets. Another requirement for CORSIA eligibility is for the credits to be issued under a standard which is approved by ICAO. And a few weeks ago, you might have followed this news, ICAO granted full approval to carbon standards for phase 1 of CORSIA. The phase 1 is between 2024 and 2026. Now, the 4 newly approved standards include Gold Standard, Verra, Climate Action Reserve, and Global Carbon Council. And you might wonder, why does this matter? So previously, only 2 standards, ACR and R3s, were fully approved. And this was a limitation, so this was limiting the credit options for airlines under CORSIA. And not only limiting, but it also put a pressure on supply availability. Now, as of October 2024, there was a surplus around 230 million ton of credits from phase 1 eligible registries. Again, this is about the registries. When we look into the more specifications, however, there's only 6 to 7 million of these issued credits meet all the eligibility criteria for phase 1. So despite the approval of the 4 new standards that broadens the pool of CORSIA eligible credits, supply is nevertheless expected to be limited. And this is also due to the fact that many of the host countries are still developing Article 6 regulatory frameworks and hence not yet authorizing credits for CORSIA use. Now, looking a little bit on the demand side, we could assume that the international aviation traffic could grow quickly, and there are various different estimates that this could be annually around 4%. However, the sectoral decarbonization is relatively slow when it comes to for technological improvements. So as a result, the cumulative estimated demand for credit is projected to be roughly around 120-130 million ton for phase 1. So by comparing the projections for credit supply and demand for phase 1, we can clearly see a potential supply deficit, which is projected to be. So you might wonder what we can expect in 2025. Now, early mover airlines are moving beyond the wait and see approach. There are several airlines who are already developing or actively developing the CORSIA strategies and securing eligible units to ensure compliance. And this is also something that we are going to see even more in 2025 as we are getting closer to the compliance deadline.
So hopefully everyone can hear me okay. This slide is great. Just a high level picture of the market demand. Markets remained resilient. This little graph here shows retirements in 2024. This is data from the public registries. And as you can see, it's not far off from the high levels in 2021, 22, and 23. The year's not over. There tends to be a lot of retirements in the last months of the year. The number of new companies publicly retiring credits keeps increasing over time, and we expect that trend to continue. And research shows that companies that use carbon credits to decarbonize are decarbonizing at roughly twice the rate of those that have not. So all in all, the demand signals show that the market is still, retirements remain strong. Next slide, please. And then looking at some high-level trends in the market in the future. The next slide here is some images from Bloomberg. Alexi, can you go to the next one, please? There we go. This shows 3 different potential scenarios for the carbon market in the future. And the high level takeaway here is that no matter, even in the most pessimistic scenario that was assessed, it still shows a growth by several factors. This is based on, whether the integrity issues are solved, whether demand is elastic or inelastic. But essentially, in 2050, the best case scenario, the carbon market could reach an annual volume of 5.9 gigatons with a 1.1 trillion valuation and prices above $200 a credit. And what this says is that even though 2024 was really a pivotal year with a lot of these integrity initiatives and various market actors, weighing in on this topic of carbon credit integrity, it was a year of reformation, and that transformation will need to continue if we want to reach that 1.1 trillion valuation as projected.
Some megatrends to watch out for in the market. On the supply side, we're seeing an increase in the supply of nature and tech-based carbon removals, and we expect to see that continue to rise. This is in response to many of the demand signals we've seen over the past couple of years for these types of credits. Also, a kind of a shift in the way that carbon credit finance will be used and what types of project types it'll focus on, with a bigger focus on sectoral transformations, whether that's Article 6 projects, jurisdictional REDD+ projects, as well as decarbonization of entire grids through some of the propositions of the Energy Transition Accelerator. On the demand side, we're seeing an interplay between voluntary and compliance. We have our national compliance schemes. You have CORSIA, Article 6, as well as the voluntary carbon market, many of which will use similar standards, and some credits will be able to be used across these different markets. So you have a kind of a segmentation of the demand drivers, which will help build momentum in the market. In terms of the maturity of the market, we're starting to see evolving and tightening regulation, which is a good sign. I think everyone in the market would like to see a more regulated market. It's better for everyone involved. There's also the crediting and authorization mechanisms becoming more complex, specifically in relation to Article 6 and CORSIA, and then changing definitions of carbon credits as an asset class from a legal perspective and how they're accounted for in balance sheets. And lastly, the digitalization within the market, which will help disrupt project generation, digital MRV, and kind of the sales within the market. So to start on the supply side, as I mentioned, we're seeing a rise of removals. 70% of all capital raised and committed between 2021 and 2024 was for carbon removal projects, approximately 20 billion of that going to nature-based solutions, and another 10 billion going towards technological removals. So a lot of this is in response to the demand signals we've seen from the market, and also from some subsidies and other kind of national level initiatives like we're seeing with CDR in the US through the DOE initiatives. And in this space, we're also seeing kind of an evolution of the methodologies and standard bodies within that. You have isometric, which is more focused on carbon removals, and then you have soil carbon methodologies, enhanced rock weathering, carbon capture and storage, as well as ocean alkalinity enhancement, and a lot more innovative kind of methodologies in this space. So you'll see kind of a larger variety of projects over time. And the way that they're financed as well. So we have like advanced market commitments on the CDR side with NextGen, one of the joint ventures that South Pole is involved in terms of kind of bolstering the innovation on CDR. You have Frontier as well in CDR. And then on the nature-based side, I think many of us have seen the developments with Symbiosis Coalition and some of the bigger buyers getting involved and committing to actually purchase within this market.
Now we are still on the supply side, and we can look into transformative action. So we can see this opportunity in both voluntary and compliance markets, but if we are at compliance markets, it's important to mention that countries start to implement their national climate actions plans, and they will soon start to seeing some challenges in meeting their NDCs and assessing the role that Article 6 could play in it. By leveraging carbon market and Article 6 in particular, we could see that there could be new types of projects that otherwise wouldn't have been viable or developed under the BCM. So this could further increase demand for ITMOs. This will be also especially helpful for hard to abate sectors like cement, concrete, or steel. But we can also think about coal, as coal is the single largest contributor to global temperature rise, as over 70% of power emissions stem from coal. However, a very interesting fact from when I first saw it is that over 90% of coal plants are shielded from competition due to regulations or long-term contract that guarantee their return. So as a result, many of these coal plants have no financial motivation to retire early. So this is also a big question that we and the market have been asking is how can we mobilize carbon markets to accelerate these plans? And there's a noteworthy initiative to mention in this area is the Coal to Clean Credit Initiative, which is now piloting the world's first Coal to Clean project in the Philippines with the support of the Monetary Authority of Singapore. And this initiative is aimed to use carbon finance to incentivize the transaction from coal to renewables ahead of time and bolstering the Southeast Asia's long-term energy security and economic reliance. And we at Southwell, we are really proud to play a part in this initiative, using the power of carbon markets to bring forward the retirement date of coal-fired power plants and replacing the electricity with renewable energy. And looking ahead, we are very much excited about the future developments and scaling up these kind of projects in this new era of carbon markets, as there are many interesting opportunities on the horizon to accelerate sectoral net zero transformation.
Next, let's examine the demand trend, right? On the demand side, we anticipate a convergence of the voluntary and compliance markets, and that would lead inevitably to creation of a segmented market. We anticipate this segmentation will likely spark competition for high integrity carbon credits. Now, early signs to this trend in the voluntary market, in our view, includes the shift in demand towards net zero claims. The number of companies that are making net zero claims continue to rise. The latest statistics suggest that about 60% of Forbes 2000 companies have established net zero targets. If we look it in revenue terms, this is 67%. This represents a year-on-year increase of 23%, as is reported by analysts and the net zero tracker. These targets are likely to necessitate the use of removals credits to achieve the net zero goals, right? Furthermore, there's an increase in regulations around environmental claims worldwide, which suggests a movement away from carbon neutrality as a claim towards more stringent ways of claiming and towards more stringent standards. This push for greater integrity and transparency is likely to drive demand for high quality carbon credits. If we see the compliance side, I would want to note that about 40% of carbon pricing instruments, meaning ETSs or carbon taxes, operational globally, already allow for the use of carbon credits. These credits could be getting generated from the geographies from the jurisdictions themselves, and in some cases also foreign credits are allowed. However, this creates the link between voluntary and compliance markets as well. Additional compliance demand is also expected to come from the first phase of the CORSIA scheme that Judith explained a few moments back. If we look ahead, the convergence on quality can be anticipated. The recently approved Article 6.4 standards, in our view, are poised to become a quality benchmark for the entirety of the market. It's also Worth being noted that independent standards like Vera and Gold Standard are already being used for transactions under Article 6.2 of the Paris Agreement, which signals a move towards a greater harmonization between the standards that exist today, the experiences that we have gained so far in the market, and the standards that are yet to come and develop under the UN mechanisms and in processes, independent processes in the carbon market, such as IFECM. We hope there is interoperability between the voluntary and the compliance spheres as the voluntary and the compliance demand interplays with each other. If we go to the next slide, the next mega trend in our view, thank you. The next mega trend in our view is regarding the maturation of this market. And from our vantage point, we see a carbon market that is ready to come of age in some ways, right? There are developments on regulations as well as on the ecosystem that supports carbon markets and carbon credit generation, as well as the infrastructure that signals towards a maturity trend, right? On the regulation side, if we look at that for a minute, we can expect to see more and more regulations on carbon markets, and we see a tightening of these regulations across the spectrum as we move from focusing on claims and to focusing on disclosures, right? Several initiatives are on the horizon, the EU Green Claims Directive, and the increased oversight we see from bodies like the International Organization of Securities Commissions, or IOSCO, as well as the US Commodity Futures Trading Commission, are indicative of this trend of tightening of regulations. The second signal on maturation of this market is coming from the opening of the debate around defining carbon credits and defining the legal nature of carbon credits. As carbon credits transition into a recognized investable asset class, we believe their definitions will evolve. Some jurisdictions are already starting to recognize their legal status. In the US, they are being classified as commodities. In Brazil, they are looked as securities. And this shows the maturation in the debate on what carbon credits are and their role as well. We are also seeing, of course, contracts has been another open question in this market. We are seeing standardized contracts now existing both in spot as well as future exchanges, hinting towards a move towards maturity of this market. Of course, another consequence of as this market becomes more sophisticated, and a transition that we witness as the market becomes more segmented, is the increased complexity in the mechanisms and the infrastructure that supports generation and transaction of credits. We are already we follow the Article 6 space very closely, and we are already seeing in some interactions between independent international standards like the Vera and Gold Standard and some national standards to be able to respond to the new UN-backed rules under Article 6, right? And we anticipate this interaction to further to just increase as Article 6 markets evolve. It's also worth noting that there are international standard these international standard setting organizations like Vera and Gold Standard are digitizing their processes. So there's a stress around digitization, and with that we hope there's an enhancement in the efficiency and transparency that this market has. Additionally, digital registry platform integrations are also being offered by various players. This ranges from exchanges like Expansive to solution providers like S&P Global Commodity Insights. Taken together, what we are looking at is a new type of carbon market taking shape, which is more sophisticated, definitely more interconnected, but also more complex than the carbon markets as we know it. And with that, we move to the next mega trend on market maturity.
Thank you, Ritika. So the last mega trend within market maturity is the digitalization of the market, and that's happening on the product development side and standards, and then also on the demand side with kind of trading infrastructure and the way that that the demand is looking at it. So some of those big developments we're seeing is kind of the digital MRV processes, the larger incorporation of Earth observation data into projects, the use of machine learning, AI, blockchain, bioacoustics for biodiversity monitoring, and much more. So what this is helping to do to the market is it's bringing about scalability, right? It's reducing some of the higher barriers to entry that came with the high cost of monitoring and verification. It's helping with efficiency within the market on the monitoring and the verification side, as I said, and then also the accuracy of the data that's in the market, which is and the way we process it with AI and machine learning and whatnot to create more reliable credits. And then lastly, the transparency within the market. So by having digital records, improve transparency, trust, and the credibility of the market overall. And as credit buyers have said, 90% actually rank MRV as a major factor in credit purchase decisions. This is largely driven by the ability to have more defensible and provable credits to reduce accusations of greenwashing. And then also on the developer side, we're seeing approximately $2.6 billion of costs related to the verification delays by 2030. So as we have a more digital market that's more efficient and stronger infrastructure within the market, it will just be better and help the market scale overall. So what are the implications for buyers from these kind of developments and these mega trends? First, if you're on a procurement team, if you manage a portfolio of credits, it helps you put in place risk mitigation measures, quality assurance frameworks, and really manage your portfolio in a way that works today and is risk adjusted for the long run as well. So what you can do today is you can start by diversifying risk, just like in any portfolio, whether that's stocks or carbon credits, you want to diversify your risk. There's a few different ways you can diversify risk. You can invest in different types of project types, different countries to reduce location risk and landscape risk. You can work with different product developers, different standards and methodologies, and just kind of diversify the overall portfolio within your company and how you choose to invest in climate action. It's also important to consider locking in future supply. The market's kind of bottomed out, many would say, in terms of the pricing of the market, and I think a lot of people are looking forward and creating price expectations for their budgets with the current pricing, which might not be the smartest. We do expect pricing to increase as there's more clarity around what is a high integrity credit, and with kind of the increase in demand drivers, as I mentioned, with Article 6, CORSIA, and national compliance markets as well. So we do expect pricing to go up, and as we've seen earlier, the market is expected to expand, and the supply will take some time to catch up. So it's good to lock in future supply. There's some great ways to do that, whether that's through offtake contracts with project developers or investing directly in projects. So that's one thing that buyers should look at now if they have the capability and I guess the budget to actually engage at that level. Furthermore, and very importantly, is to increase the transparency in the way that we report the credits we use, right? One of the best ways to mitigate risk is to just be very transparent in the way that you use credits. What is the goal of your organization and how you choose to use credits? What is the quality assurance framework you use to assure the credits that you're buying align with your expectations? And then being transparent about the evolution of that process at your organization. This can all be shared within your sustainability report and helps mitigate risks up front, right? The reality is that the carbon market itself is a market that has some level of unmitigatable risk, right? It's not your traditional commodity market. You're not just buying a bushel of corn that is a bushel of corn. You're buying a carbon credit from a project that might be over 20 or 30-year time period. So there's the ability for context to change and things to occur. So there is some level of risk that you have to be comfortable with taking and acknowledging that within your reporting, and that while you understand these risks, you do believe it's more important to fund climate action than to just not engage in climate at all, is a great way to start in the way that you actually go about reporting your usage of carbon credits. So what are some buyer considerations when considering sourcing carbon credits? And how can you actually go and procure these credits, right? In the short term, there's a spot purchase. I don't need to talk too much about this. I think everyone knows about spot purchases. This is how a majority of the market transacts. There's also fill orders, a bit more of a unique approach, really relying on kind of selecting a project list of projects that you're okay with purchasing. Maybe you have a price that you're willing to purchase those projects up to, and then working with an external procurement provider to actually go and procure those credits on your behalf, given your volume restrictions, your pricing, and the product list that you have set out for that procurement partner. That's something that Southpole works with some companies, and it's a great way to kind of get a portfolio that is in line with your needs, right? And then, as I mentioned earlier, we're seeing a lot more movement towards offtake agreements and direct investment, very similar to renewable energy markets and the kind of rise of power purchase agreements. With forward offtake agreements and direct investment, you can really secure your stream of credits at prices that work for you and allow you to kind of reduce your overall due diligence cost, because you do a lot of due diligence up front, but then you might have a stream of credits from that project for the next 10 or 15 years, and will also reduce your pricing risk as the market adjusts to ongoing trends in demand and supply. The last one is kind of investment facilities and funds, where you can invest in kind of a group of projects and get already a diversified portfolio as well. Not something we're seeing as much from the corporate side right now. There's a lot of funds and facilities out there, usually by speculators and intermediaries in the market, but we expect to see a bit of a shift towards that as well. So we just want to thank everyone for being patient with us as we go through some of the technical difficulties with this presentation, and we're going to actually revisit some of the earlier slides that we were having some issues with. So just bear with us as we go back to those slides. All right. So at the start, I talked about how 2024 has been a pivotal year for carbon markets and the reformation of the markets. A lot of that owing to greater standardization of quality criteria for carbon credits, really driven by the ICBCM and the work they're doing with the core carbon principles. There's further guidance around corporate climate claims, especially in the EU. The UK just provided some guidance, actually naming the ICBCM at COP29, and the US has also provided guidance this summer, right? And then we have the voluntary carbon regulation on how credits are used, especially in the EU and in California, and kind of a new era for global carbon markets with Article 6 in CORSIA, as Judith and Ritika have mentioned throughout this webinar. And overall, despite the challenges of the past couple of years, we're still seeing a very resilient market, right? Retirements are still at record numbers from years past, and despite slips in certain prices of projects, we have seen some project types remain strong on the pricing side, so it's a good sign moving forward. And as the market continues to mature, the supply improves and kind of reacts to demand signals, we will see that continue to pick up. So this is the last slide that we're going to go back over again, and that's about the standardization of quality criteria. It's a really important slide. Many of you probably do know the ICBCM, the international kind of framework for what is a high quality carbon credit, really assessing at the standard level, is that standard in line with what is necessary for high quality crediting, and then methodologies and the ways that methodologies are used and applied by product developers. So having the ICBCM and the core carbon principles creates kind of a harmonious approach to standardization while still allowing the diverse and stratified kind of standard bodies within the market and the resilience that comes with having that competitive market of standard bodies. So it provides the simplicity for your average buyer and demystifying the complexities of the market and really kind of creating that understanding of what is high quality within the market. Now, for buyers, there's some things you should keep in mind when procuring and using core carbon principles. To start, a lot of methodologies have not been assessed yet, so there is a very limited supply of credits on the market. And even with the methodologies that have been assessed, many of these methodologies are newer methodologies, and there are projects that have not shifted over to those methodologies yet. So even once they have been approved or CCP eligible, there will be a bit of a delay in terms of getting credits onto the market. Specifically, Red Plus, we've seen 3 methodologies in the Red Plus space that got approved by CCP, but there are very few credits on the market that are CCP Red Plus credits. A lot of Red Plus projects are still using older methodologies, but will be required to shift over to these newer methodologies. So that supply is still lagging behind. Something to keep in mind as a buyer, just keeping expectations realistic. Also, the core carbon principles themselves only address projects at the standard and methodology level, not down to the individual project level. So when conducting due diligence, it's still important to actually look at individual projects and a little bit more into the details of that project and how they apply those methodologies. Now, you could do that through in-house due diligence. You can use external third-party resources like a due diligence team from another company or third-party ratings. There's various ways you can engage with that, but something to keep in mind. Moving forward, what do we expect in this standardization? Well, we're still waiting to see further assessment of methodologies and standards. There are newer standards that have joined the market and are applying to ICBCM to get approval. So it'll be interesting to see how those play out. And then on the methodology side, we're still waiting on clean cooking as one of the big methodologies that has yet to be assessed. And we're expecting to see that come out in 2025, according to recent announcements. And then overall, just a further kind of approval of ICBCM across different spaces, right? It's definitely has a strong foothold in the voluntary carbon market. We've seen the US and the UK reference it in their guidance. It's been talked about in relation to Article 6 and other markets and in VCMI. So to see that kind of momentum continue will really help to standardize the market and bring in capital and bring in demand for the market overall. Well, thank you everyone so much for joining today. We might have time for just a couple questions, and we appreciate your patience as we work through these technical difficulties.
So thank you so much, Alexi, for revisiting the previous section on the VCM. And thanks so much for the audience for sending us so many engaging questions. Now, just picking some of them due to the limited time. So we have an interesting question, which is, will the VCM market remain muted in 2025? And when will the next boom happen? I believe this question belongs to our VCM experts. So maybe Lauren, you want to answer this question.
Yeah, sounds good, Judith. Thank you. I think a lot of external sources on this topic have said that the market will become a growth market again in 2025 or soon after. So I think the expectation is that things will be picking up very soon in the coming years.
Great, excited to see that. We do have maybe time for another question. So this is also very interesting for me, coming from the compliance markets. So is there still a role for independent standards like Vera or Gold Standard in the compliance markets? So I'm gonna ask this from my team member and fellow colleague, Ritika, over to you.
Thank you, Judith, and indeed a very interesting question. From our perspective, there's very much a role for independent standards like Vera and Gold Standard in compliance markets. I spoke briefly about Article 6.2 trades, and Article 6.2 trades can use independent use standards, and independent standards are being used as we speak in the trades that have happened in 2024. South Pole facilitated the first sort of end-to-end trade for a project in Thailand a year ago, and this project was developed using the Thailand's domestic standard called TBER, right? For Article 6.2, which is also, by the way, the dominant source of demand right now under compliance markets, it really depends on the buyer and the seller country, right? If the buyer and seller country agree on a certain set of standards to be used to develop credits with, then those standards fly. And what we are currently seeing is that the buyers that are engaging in this market have been open to the existing standards in the market. Of course, an, another sort of space and role for independent standards from our perspective is in the learning that has gone into evolution of these standards over the years, right? There is a lot of space for increased alignment and learning in the sort of in the growth of carbon markets 2.0, especially now that we have the UN standards are here. We hope and we see initial we see this alignment taking shape, right? For instance, there is similarity there, one can see speckles of similarity in the thinking that ICVCM has been working on certain methodological questions around removals, and the work that A64's governance body SBM has done on those topics. The Sustainable Development Tool that was launched also as part of the Baku decision for Article 6.4 does have broad stroke inspirations from the Sustainable Development Tool that is used in the gold standard. And we hope that this inspiration goes the other way as well. There's a lot. The Article 6.4 supervisory body is working on some very seminal questions around what high integrity means under Paris Agreement, what does Paris alignment mean, and all these topics as they get unpacked under the SBM will reflect and hopefully inform the debate that we see ongoing for now a couple of years in the voluntary market. So what we hope in the end is that are two things. One, that a wide array of standards are available for use for us to move into a market where compliance and voluntary demand coexists, and that there is scope and sort of that this market is permeable in the sense that inspirations go both way from and we learn from what we have done in the market, and figure out new questions we have in front of us. Back to you, Judith.
Thank you so much. And thank you so much for our audience who joined us for this session where we unpacked 2024, which was clearly a pivotal year for carbon markets. And we have so many exciting developments to look forward in 2025, whether it's VCM, CCPs, Article 6.4, CORSIA, and we apologize for the technical difficulties, but please feel free to follow up with us individually or as with a team. We are more than happy to answer any questions, and we will follow up with the questions as well. And thank you so much for joining, and please follow our social media for another events like this or informative sessions. Thanks again, and have a wonderful evening, morning, midday, wherever you are.
Thank you, everyone.